The focus of Australasian markets yesterday was the Australian Producer Price Index for the December quarter. This precedes the release of the Consumer Price Index, which is out today. Producer prices were a bit weaker than expected over the December quarter, remaining broadly flat, increasing just 0.1%, much below market expectations. This adds some downside risk to the Consumer Price Index, which is due out today. Contributing to the weaker surprise was much lower import prices for imported goods, falling 4.4%. However, prices for final domestic goods actually increased 0.7%. And concerningly, for the Reserve Bank of Australia, we started to see evidence of lifting construction costs. There are some concerns over 2011 we'll see increased pressure on the construction industry in Australia from the mining boom, as well as now increased pressure from the Queensland floods damage that needs to be repaired. Rising construction inflation is likely to be a key concern for the RBA over the next year, and many economists are now expecting that the Reserve Bank of Australia will have to deliver one more rate hike over 2011. However, for the here and now, the Producer Price Index offers some downside risk to today's CPI outturn. Markets' expectations are currently centred on a 0.7% increase. Trading in New Zealand foreign exchange markets was extremely quiet yesterday, with the Wellington anniversary holiday contributing to much of the lull. The only action was seeing the New Zealand dollar outperform the Australian dollar, following the weaker than expected Australian price data. Nonetheless, the New Zealand dollar did receive a bit of a boost on the back of increased US confidence, which saw equity markets rally. The New Zealand dollar lifted from just under 76 cents to 76.40. US equities were boosted on the back of increased takeover activity and share buyback activity, with very little data to support the increase. With markets fairly quiet over the early part of this week, all focus is on the Reserve Bank of New Zealand official cash rate decision on Thursday morning at 9 a.m. We're expecting the Reserve Bank of New Zealand to leave the cash rate on hold at 3%. The Reserve Bank's statement is likely to continue to keep the cautious tone it had in December. Indeed, the Reserve Bank noted in December that it had been surprised the lack of traction low interest rates have had on stimulating domestic activity. Since December, domestic activity has since proved weaker than expected, and inflation indicators have remained extremely subdued. Reflecting this, we do not expect the Reserve Bank to increase the OCR until well later this year. We expect the first increase to now be in September. We believe that there are three areas that the Reserve Bank will be looking for improvement in before they are willing to increase the interest rates. The first is the housing market, with the Reserve Bank looking for some stabilisation and perhaps even some improvement in prices. The second is a more sustained improvement in business investment. And the third is a lift in appetites for business credit. We believe that when the Reserve Bank has seen evidence of these three areas improving, perhaps around the middle of this year, they'll then be more comfortable with removing monetary policy stimulus from very low levels in about September.